What's up, guys? I'm filming back to back again, so here's another video. This time I'm going to get into common and preferred stock. So you're probably wondering, well, I'm always in common stock when I invest. So what's the difference between that and preferred? If you don't know that, you know common stock is all about voting rights. So if you're a common stock shareholder, you have voting rights. You can vote on the company's sales, media rights, etc., whatever you have or whatever's going on. So if they send you a report and say, hey, this is the voter report, tell us what you want. You want to vote for certain people on the board or certain people that's in management, you can do that as a common stock shareholder. Preferred stock. Not a lot of people are familiar with preferred stock. If you took a finance class, yeah, you know about it, but we're talking about the average people that know about investing. So preferred stock, and I'm back in the book again, so that way, as I say, SEC, FINRA, I'm good. So the book says preferred stock, and also some of my knowledge as a finance major from the University of Tampa, you receive dividends fixed. See, as a common stock shareholder, you don't have entitlement of dividends. And that is always stressed. So people are like, man, I bought the stock, bro, but I am not receiving dividends. As a common stock shareholder, you're not entitled to them. You have your voting rights, but you're not entitled to having dividends. Preferred stock, you have priority. See, this is how it goes in terms of payout for stuff. It goes your debt holders, then it goes your preferred, then common. Because debt holders have a contract. So that company, if they dissolve, they owe the debt holders first. They owe them first. Secondly, preferred stock. Because the dividend's fixed. So I'll stay, dividend's fixed. Common stock, you're not entitled to receive anything. So think about what you're investing in when you see those three: debt holders, preferred, common. So preferred stock, it's equity security. We already know, just like common stock, it's fixed income because the dividend is fixed. So it says preferred stock and bonds are fixed income securities and are sensitive to changes in interest rates. So as interest rates go up, the prices will fall and the yield will rise. So therefore, say if the rates go up 1%, then the price will fall of that preferred stock, and then the yields will rise. Then it says it pays a dividend that is stated as a percentage of par. So par value for bonds is $1,000. Par value for stock is usually $100. So let's give an example. $100. Say the dividend payout ratio is 10%. So now on that $100 that you spent, you're getting 10% back, which is obviously $10. So you have to remember, preferred stock may also pay a variable rate dividend. So it just depends what the company has, what it states. But the thing is about preferred stock, you may have a fixed dividend, but you don't have voting rights. So basically, it says usually does not receive preemptive or voting privileges. So are there some out there? I don't know personally. I have to do some more research on that. But you basically are giving up your voting rights for fixed income. Whereas a common shareholder, you could have capital appreciation much more or less, but you also have voting rights. And it says preferred stock is generally less volatile than common stock. So with preferred stock, you won't have to worry about fluctuations in the markets as much as common stock. But I think with a common stock, you have better chance for capital appreciation. So you're taking a higher risk being on common stock than preferred stock. And most of this video is going to be about preferred stock anyways. So it says preferred stock generally offers less potential for appreciation than common stock because it's a fixed income security. So you're holding on mostly to a dividend rather than holding on to the stock itself and saying, I'm waiting for the stock maybe to rise up, 50%, 70%. Preferred stock, you're in there for the fixed income. Something a little more stable, a little more safe, but at the same time, you're giving away some things that you can have with common stock. So it's all about your choice. It's all about what you want to have. If you want to have a stock that you are saying, I'm taking the risk, I want the high reward, then you go in common stock. I got voting privileges. But if you were saying, I want something a little more fixed, a little more stable, something that is not really volatile to the market, get a preferred stock. And preferred stock, I'm going to list out some things. Preferred stock may have all these characteristics or none, some. So there's 4 things about preferred stock. It's cumulative, and that means that all dividends must be current on cumulative preferred stock before dividends are paid to common stockholders. So what am I saying? So I'm saying that the company must pay overdue and current dividends before declaring dividends to common shareholders. Now, we learned this in finance class at UT, and it's just that, like I said, the three levels of the hierarchy. So you got debt holders, preferred, common. So before any common shareholders receive dividends, preferred shareholders must get their cut. So let's say a company's backed on dividends. Common shareholders are saying, well, where's my dividend? You guys said you declare a dividend for us. They have to pay the debt holders first, and they have to pay the preferred shareholders first. So if you don't get anything for that quarter, preferred shareholders got it. That's if they pay it out to them too. But here's the thing. Like I said, if they're backed up on that, preferred shareholders get the current dividends before the commons. So they have, the priority. So that's that. So cumulative. You have priority over common shareholders within dividend payouts. Convertible. So convertible means that you can convert the stock. So you're saying what? So it's meaning that the price of convertible stock is likely to fluctuate, but you can convert them into other shares, common stock. So you have the option of turning that preferred stock into common stock, but there is a conversion rate. There's a conversion price. So therefore, maybe it's higher, maybe it's lower. It just depends on the market timing. But it says that when the interest rates are stable, it's trying to fluctuate, maintain parity with the common stock. So it says conversion will increase the number of common shares outstanding and dilute the earnings per share. So if you're trying to convert a stock, may or may not have the same value. See, it tries to, maintain parity when being convertible, but at the same time, you may or may not get what you want in terms of pricing. But you can convert those shares. So number one, you have priority over common shareholders. Number two, you can convert the shares if you want to common stock. And then that's when you take the capital appreciation risk and you take all the risks of being a common shareholder. See, now you're not really on fixed income anymore. Now you're more on, I'm taking a risk on wanting capital appreciation. So remember that. Participating. Dividends are fixed as a minimum, but not to a maximum. So participating basically means that your preferred share will have a fixed income on dividends as a minimum, but no amount to a maximum. So they have to set a limit at the low end, but the high end, they're not fixed. You can have as much high end as you want. Company, that is, could pay out to the shareholders, high end, that is, but it's fixed to a minimum, but not to a maximum. So you are entitled to your minimum dividend, but you might have additional dividend. Who knows? And they're callable. That means they may be redeemed by the issuer at set premium over par at a specified date. So there's a lot of things going into calling bonds, calling preferred, but let's just say that they're callable. So if the issuer of the preferred stock wants to set it at a premium over the par value, so over $100, then they could call it back. Now, obviously, callable stock favors the issuer because it says cumulative, convertible, and participating stock preferred to shareholder, because you have priority over common shareholders. You can convert into any shares you want. And also, they're fixed to a minimum, but not to a maximum. But they're callable. It favors the issuer because they can call at any time. So it's like, oh man, I just got my stock. Oh, call it back. So obviously, you may take that hit on that because like, man, I want to hold it for longer. But callable favors the issuer. So that's preferred stock right there. Common stock, you have voting rights. You take the risk of cap appreciation, high risk, high reward, and anything that you put it into. I got into my last video about, the types of equity securities, classifications. So I can do another video on common stock. Mostly, I just went over the basics of common stock, but I will get into another video probably explaining more about common stock. So this is preferred stock. It's a fixed income security. So if you want to invest in that, do your due diligence and you make the decision. Not telling you what to do, just give you information. So guys, thank you for watching another video and tune in for the next one. Thank you.